Imagine, if you will, a 95-year-old man.
Okay.
He has just stepped down after 60 continuous years of running a global financial empire.
Right. 6 decades.
Yeah, 6 decades at the absolute pinnacle of capitalism. And, most people in that position, at that age, they're long gone from the boardroom.
Oh, absolutely. They're on a beach somewhere.
Right. They're on a beach. They're playing golf or, writing their memoirs. We're just finally resting.
Yeah, just enjoying the quiet.
But the man we're looking at today, he wakes up every single day, well before the opening bell rings on Wall Street, and he picks up the phone to call his trading desk.
It's unbelievable.
And he does this while sitting on a cash pile of over $370 billion.
Yeah, that visual is just staggering. It completely upends, our conventional understanding of what corporate succession is supposed to look like.
Right.
Especially for someone who literally has nothing left to prove. I mean, what we are witnessing isn't really a retirement. It's more like a metamorphosis of control.
Exactly. Yeah. And welcome to today's deep dive. We are looking at a very rare, just incredibly candid snapshot of Warren Buffett's mind in the year 2026. We're analyzing a man who has shaped the financial landscape for over half a century. And he's currently navigating this highly complex transition of power, a deeply uncertain geopolitical landscape, and, the final structuring of his own legacy.
A lot to unpack.
It really is. And our primary source for this exploration is the CNBC Squawk Pod interview. This is from March 31st, 2026, hosted by Becky Quick, Andrew Ross Sorkin, and Joe Kernan.
And, the timing of that specific interview is just crucial.
Why is that?
Well, this marks Buffett's very first extensive media appearance since he officially handed over the chief executive title of Berkshire Hathaway.
Wow, okay.
Yeah. And to supplement that CNBC audio, we are also analyzing an accompanying transcript summary. It details the exact financial metrics, the current market temperatures, and some highly revealing personal updates that Buffett shared during this appearance.
It really gives us a window into the exact mechanics of how a $370 billion war chest is being managed on a random Tuesday morning.
Right, exactly.
We're going to get into the exact mechanics of that war chest, the reality of his daily trading calls, and a rather shocking admission about his largest stock holding.
That part is fascinating.
Oh, really is. But before we look at exactly what he's doing with that capital, we have a quick note for our community.
Go for it.
To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. And to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Perfect. And of course, we have to give our standard disclaimer here.
All right. Always important.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice.
Yeah. Conduct your own due diligence before making investment decisions.
Exactly. And if you like to access wider topics including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Okay, let's unpack this.
Let's do it.
So the headline that hit the wires in early 2026 was pretty straightforward. Warren Buffett officially hands over the CEO title to his successor, Greg Abel.
Right, which officially ends a 60-year run as the chief executive.
60 years. That corporate reign outlasts the entire life cycle of most publicly traded companies.
Easily, yeah.
So he tells the press that Berkshire Hathaway is now better positioned for long-term survival than any other company on earth. The baton has been passed. The succession plan is active.
But then, right.
And then we look at the actual daily behavior.
Yeah, what's fascinating here is the contrast.
He retains the title of chairman, which, that's standard. But he continues to go into his Omaha office every single day.
Every day.
And according to the sources, every day before the market opens, Buffett calls his financial asset manager, who is referred to in the materials simply as M, to discuss the market temperature and to actually execute trades.
Right, which fundamentally alters how we have to view this so-called transition.
Totally.
You really have to look at the dichotomy between the legal structure of the corporation and the psychological reality of its founder.
Yeah.
Yes, Greg Abel is the chief executive officer. He has the ultimate legal and operational authority over the sprawling Berkshire empire. The energy companies, the railroads, the insurance operations.
Right, the whole massive machine.
But Buffett's daily calls to M reveal that the gravitational pull of capital allocation, it still centers heavily around that Omaha office.
But wait, if Abel is the CEO and Buffett is still executing trades with M before the bell, isn't that creating a shadow management structure?
Yeah.
Because Wall Street traditionally hates shadow management. It creates ambiguity.
They use it, yeah.
Like, if you're an institutional investor holding Berkshire stock, you want to know exactly whose hand is on the steering wheel. If Buffett is still making the calls, is it really a handoff? Or is it just a title change to placate the board?
It's a highly unusual structure, for sure, but you have to understand the specific mechanism they've put in place to prevent that exact ambiguity.
Okay, what's the mechanism?
Buffett has established a very explicit public rule regarding his relationship with Greg Abel. He remains deeply involved in the investment decisions, operating as what the sources call a behind-the-scenes strategist.
Okay. So he's pitching ideas.
Right. He can pitch ideas, he can analyze the macro environment, and he can execute trades with M. However, Buffett has made a binding public vow not to override or make any decisions that CEO Greg Abel believes are wrong.
Wait, really? So Buffett has the ideas, but Abel actually has the ultimate veto power.
Yes, exactly.
That is a fascinating dynamic. I mean, it requires a massive amount of ego suppression from a 95-year-old billionaire who has, frankly, been right more often than anyone else in history.
It really does. And conversely, it requires an immense amount of fortitude from Greg Abel.
Oh, can't even imagine.
Right. Imagine being the guy who has to look across the table at the Oracle of Omaha and say, "No, Warren, we aren't doing that trade."
That sounds terrifying.
Precisely. And that's why this isn't a traditional shadow management situation. You know, in a toxic corporate transition, the former CEO retains this informal veto power and secretly undermines the new executive.
Right. We see that all the time.
But here, they have completely inverted it. The former CEO retains operational momentum, but explicitly submits to the new executive's veto.
Wow.
It's a system of checks and balances where the founder essentially becomes the most overqualified senior analyst in the world, reporting to his own successor.
It reminds me of a legendary film director. You see this happen in massive movie franchises sometimes.
Oh, yeah. How so?
Well, the legendary director finally hands over the camera to a new, younger filmmaker. And he tells the press, the franchise is in great hands. I'm just producing now.
Right, right.
But then, every single morning, the old director is still sitting in the editing room. He gave away the camera, but he kept the scissors.
That's a great analogy.
But in this case, Buffett kept the scissors, but gave Abel the right to throw the final cut in the trash if he doesn't like it.
That's an excellent way to conceptualize it. He gave away the camera, but kept the scissors. And what we're looking at is the profound difficulty of relinquishing control of a compounding machine that is so fundamentally tied to your own cognitive architecture.
Yeah.
Berkshire Hathaway isn't just a company to him. It's a real-time ledger of his rational decision-making over 60 years. To simply walk away and stop making those daily calculations, it would run counter to his basic neurology at this point.
If you're listening to this and you've ever had to step back from something you built, maybe you handed over a family business or you stepped down as a senior partner at a firm, or even passed on the leadership of a community project, that psychological friction.
Absolutely. It's universally difficult.
How do you relinquish control of something that is literally your identity? Buffett's solution is brilliant in its pragmatism. You don't step away from the work, you just step away from the ultimate authority.
Right. You keep doing what you love, but you formally remove your ability to be a bottleneck.
And the reason he is still so hyper-focused on those daily calls to M, the reason he can't simply step away, brings us to the most staggering data point in this entire interview.
Yeah, the cash.
He is tasked with managing the largest pile of dormant capital in corporate history, the $370 billion question.
It's just a mind-numbing number.
Let's get deeply into the mechanics of this, because this number is almost difficult to comprehend, and it really defines his entire reality in 2026.
It dictates everything he's doing right now.
So Berkshire Hathaway is sitting on a cash and cash equivalent reserve of over $370 billion as of year-end 2025. And according to the sources, just this week, which aligns with late March 2026, they went into the market and purchased another $17 billion in U.S. Treasuries at auction.
$17 billion in 1 week.
$17 billion in a single week, just parked in government debt.
To understand the gravity of that allocation, we have to look at the underlying philosophy of capital deployment and the equity risk premium.
Right. Break that down for us.
Well, most investors, particularly retail investors, they despise holding cash. They view cash as a melting ice cube.
Especially when inflation is high.
Exactly. Especially in an environment where inflation is a persistent threat. They want capital deployed, earning a yield, compounding in equities. But Buffett has deliberately parked the vast majority of this $370 billion in short-term U.S. Treasuries.
And the why is the most important lesson here, right?
Yes. He explicitly stated in the interview that current market valuations completely lack appeal. He actually used the word unexciting.
Unexciting, which is a very polite Midwestern way of saying that the broad market is ridiculously overpriced.
Very polite, yeah.
But I want to challenge the strategy here for a second.
Yeah.
If you have $370 billion and you aren't deploying it into businesses because the market is unexciting, aren't you essentially trying to time the market? And isn't market timing the exact thing Buffett has spent 60 years telling everyday investors absolutely not to do?
That is a critical distinction to make, and it's a very common misunderstanding of his strategy. He is not timing the market. He is pricing the market.
Okay, what's the difference?
Market timing implies making macroeconomic forecasts, guessing what the Federal Reserve will do next month or predicting a recession and moving in and out of equities based on those guesses.
Right.
Buffett doesn't do that. What he is doing is applying a strict, mathematically rigid hurdle rate based on intrinsic value.
Let's break down that hurdle rate for the listener.
Yeah.
How does, say, a 5% yield on a U.S. Treasury fundamentally alter his willingness to buy a company?
It all comes down to opportunity cost.
Okay.
Think about it. When interest rates were near zero for the better part of a decade, the risk-free rate was effectively zero. That meant that if you bought a business that yielded a 4% or 5% return on capital, you were still generating a premium over government bonds. The hurdle to buy equities was very low.
Because cash paid nothing.
Exactly. But in 2026, if a short-term U.S. Treasury is guaranteeing you a risk-free return of, let's say, 5%, that becomes your baseline.
Yeah.
Any equity you purchase must offer a significantly higher expected return and equity risk premium to justify taking on the operational risk, the execution risk, and the market risk of owning a business.
Right, so if treasuries are paying 5% guaranteed, you probably need a business to realistically project a 9% or 10% annual return just to justify buying it.
Exactly.
And if the broad market is trading at record high multiples, those 10% returns simply aren't mathematically feasible. Imagine holding a wallet with $370 billion while walking through a massive shopping mall but refusing to buy anything because it's all marked up 10%.
Built in.
Actually,
Right.
It's not a wallet at a mall. It's more like a pressurized accumulator in a hydraulic system.
Oh, I like that.
The longer you hold it against the pressure of inflation, utilizing those 5% treasury yields to keep pace, the more explosive the kinetic energy when you finally release the valve into a genuinely distressed asset.
That is a much more accurate analogy. He is building kinetic energy, and he uses specific macroeconomic tools to gauge the overall pressure of the system.
Like what?
Well, this brings us to the concept of total market temperature. It's often measured by what the financial world literally calls the Buffett Indicator.
Ah, yes. This is the metric we mentioned at the top of the deep dive, which you can track via the iOS app.
Exactly. And let's explain the mechanics of the Buffett Indicator because it perfectly illustrates why he is holding $370 billion on the sidelines.
Yeah, let's break it down.
The Buffett Indicator is fundamentally a ratio. It takes the total market capitalization of all publicly traded U.S. stocks and divides it by the latest gross domestic product, or GDP, of the United States.
It's elegantly simple. It essentially asks, what is the total price tag of corporate America compared to the total economic output of the country? Historically, a ratio around 100%, meaning the stock market's value is roughly equal to the GDP, suggests a fairly valued market.
Yes, historically.
When it drops significantly below 100%, the market is undervalued. But when it stretches far above 100%, approaching 150%, or even 200%, it signals severe overvaluation. The stock market is essentially outrunning the actual economic reality of the country.
And in 2026, with the market valuations he's looking at, that indicator is flashing red.
Bright red.
The market cap is vastly disconnected from the underlying GDP growth. So when Buffett looks at the landscape, he sees a market priced for absolute perfection, offering very little margin of safety while simultaneously offering him billions of dollars in guaranteed risk-free interest just to wait.
And waiting is his superpower.
He really is.
If we connect it to the broader historical context, you have to realize why he is immune to the fear of missing out that plagues so many investors.
Yeah, FOMO doesn't exist for him.
Why can he sit on $370 billion while other funds are scrambling to chase a 5% market rally? Because he has lived through at least 3 distinct market crashes of over 50% since taking over Berkshire Hathaway.
3 times where the global financial markets literally lost half of their value.
That's wild. We are talking about the 1973-1974 bear market, the bursting of the dot-com bubble in 2000, and the great financial crisis in 2008.
Right.
When you have successfully navigated 350% drawdowns, your definition of a dip fundamentally changes.
It absolutely does. Let's look at the 1973-1974 crash as the perfect precedent for his current behavior.
Okay, take us back.
In the early 70s, you had the Nifty 50 era. This was a group of large-cap stocks that everyone believed were one-decision stocks. You just bought them regardless of price because they were great companies.
Sounds familiar.
Exactly. Valuations went through the roof. Buffett largely sat on the sidelines, much like he is doing now. Then the oil shock hit, inflation skyrocketed, and the market collapsed by nearly 50%. It was a period of intense pessimism.
And what did Buffett do?
Well,
that was when he famously said he felt like an oversexed guy in a harem. He started buying aggressively. He bought his massive stake in the Washington Post during that exact period of peak panic.
Exactly. He waited for the pressure valve to blow, and he did the same thing in 1999 during the dot-com boom.
Oh, he was ridiculed during that time.
He was mocked by the financial press for refusing to buy tech stocks. He sat on cash, took the criticism, and then when the bubble burst, he deployed capital into deeply undervalued traditional businesses.
Right.
And again, in 2008, when the banking system was on the verge of collapse, who did Goldman Sachs and General Electric call for emergency capital?
They called Warren Buffett.
Because he was the only one with the liquidity to act as a lender of last resort.
So when people today see the market drop 5% or 10% and they scream that it's a generational buying opportunity, Buffett looks at a 10% drop and yawns.
Literally yawns.
The analysis of his behavior here suggests he is waiting for a true, meaningful plunge. He is waiting for the moment when capital completely dries up, when credit markets freeze, and when high-quality companies are desperate for liquidity.
Right.
When that happens, $370 billion isn't just money. It's a structural advantage. It allows Berkshire to dictate terms that no other institution on earth can demand.
But it's important to note that he isn't entirely dormant. The sources reveal a very interesting caveat here.
What's that?
Even with these sky-high valuations, the interview highlighted that he is still evaluating projects. He even teased the hosts, noting that he recently made a tiny new purchase.
A tiny purchase.
Yeah, he absolutely loves keeping the market guessing.
Which is such a classic Buffett move. A tiny purchase for Berkshire could still be a multi-billion-dollar acquisition.
Yeah.
But in the context of a $370 billion reserve, it's a rounding error.
Exactly.
But it proves that the machinery of Berkshire is still humming. The analysts are still running models. He is still reading annual reports. He is just demanding a margin of safety that the current market refuses to provide.
Which brings us to a highly related and, frankly, psychologically fascinating pivot in the interview.
Okay, let's hear it.
Because while he isn't finding massive new targets to acquire in this overvalued environment, he shared some incredibly surprising and somewhat vulnerable thoughts on his biggest existing target.
Yes, the Apple confession.
This is huge.
If you are an investor, this might be the most relatable part of the entire 2026 interview, which is wild to say considering the numbers involved. Apple remains Berkshire Hathaway's largest single investment.
By far.
The scale of this trade is historic. Buffett estimates that Berkshire has made over $100 billion from the Apple trade alone.
$100 billion.
In pure profit.
The mechanics of how they built that Apple position are worth reviewing because it highlights his evolution as an investor.
Yeah, how did that start? Because he hated tech for a long time.
Historically, Buffett avoided technology because he claimed it fell outside his circle of competence. But his lieutenants, Todd Combs and Ted Weschler, initiated the Apple position.
Right.
And once Buffett recognized that Apple wasn't just a tech company, but fundamentally a consumer products company with unprecedented brand loyalty and pricing power, he scaled the position massively.
And then Apple helped them out, too.
Yes. As Apple aggressively bought back its own stock over the years, Berkshire's ownership percentage steadily increased without them having to spend an additional dime.
It's a masterclass in compounding. You would think with a $100 billion profit, he would be taking a victory lap on CNBC.
You'd think so.
But instead, we get this rare, almost pained admission. The sources indicate that late last year, Berkshire trimmed their Apple position. And in this interview, Buffett openly confessed, "I sold too early."
Let's really analyze the psychology of that statement.
That's wild.
You have the greatest capital allocator of our time, a man who has generated $100 billion in wealth from a single equity, and he is sitting there on national television harboring regret.
Yeah.
He stated very clearly that if he could do it over again, he would have held more. This illustrates the fascinating paradox of the investor's mindset. Even at the absolute pinnacle of success, The human brain is wired to focus on the friction. It focuses on the misstep.
But here's where it gets really interesting. Let's look at the math of the present moment, because this is where his discipline completely overrides his regret.
Okay.
Apple stock, as of this March 2026 interview, is currently down over 14% from its recent high. It is down 6% this month alone.
Right.
So as an outside observer, you might logically think, okay, Warren, you regret selling. The stock is now 14% cheaper than it was. Why not just buy it back right now and fix the mistake?
Makes sense on paper.
But what does he actually say?
He says that despite the 14% drop, it is still not attractive enough to buy back into in this current market.
It seems baffling on the surface. I mean, he deeply regrets selling. The price actively drops, giving him a discount. But he still refuses to buy. How do we explain the mechanics of that decision? Why is a 14% discount not enough?
It comes down to two critical advanced investing concepts that separate retail logic from institutional discipline.
Okay, lay it on me.
Absolute valuation versus relative price action, and portfolio position sizing. Let's tackle absolute valuation first.
Sure.
Just because the stock is down 14% from its all-time high does not automatically mean it is trading below its intrinsic value.
Right. A stock can fall 14% and still be fundamentally overvalued?
Exactly. When retail investors see a stock drop from $200 to $170, their brain anchors to the $200 price. They think, oh, it's on sale for $30 off.
Classic anchoring bias.
But Buffett doesn't look at the historical stock chart. He looks at the discounted cash flow, the DCF model. He projects the future cash flows that Apple will generate over the next decade, and he discounts those cash flows back to present value using a discount rate.
And as we discussed earlier, if Treasury yields are high, that discount rate goes up.
Exactly, which lowers the present value of those future cash flows.
So the math is telling him that even at a 14% discount from the high, the current price of Apple does not offer a sufficient margin of safety compared to simply holding cash yielding 5%.
Right.
He is basically saying, I wish I hadn't sold when I did because I missed out on some upside, but I am not going to compound that emotional regret by deploying capital into an asset that still doesn't meet my strict mathematical hurdle rate today.
Precisely.
All right.
Emotional regret does not alter the math of a discounted cash flow model. And the second critical factor here is risk management through position sizing.
Oh, this is important.
Buffett explicitly stated in the interview that he is very happy Apple is their largest holding. However, he emphasized that he does not want it to be as large as all his other holdings combined.
That is a crucial point about tail risk. If you let a single asset, even one as dominant as Apple balloon, to represent 50 or 60% of your entire equity portfolio, you are exposing the entire institution to concentrated sector risk.
It's just too much exposure.
What if there was a massive geopolitical shock that disrupts the semiconductor supply chain in Taiwan? What if there was a fundamental shift in consumer hardware preferences?
Right.
No matter how great the business is, having too much of Berkshire's net worth tied to a single tech company violates his core principles of portfolio defense.
And he noted that buying more is not impossible if the price drops to a truly attractive range. But he was definitive with the hosts, not in this market.
Definitively not.
He demands a valuation that justifies both the opportunity cost of his capital and the concentration risk to his portfolio.
If you've ever held onto a stock too long because you were terrified of missing out on another 5% gain, or if you've sold a winner and spent the next year agonizing over the lost profit, look at Buffett.
He's human too.
Exactly. Even the guy who made $100 billion on Apple feels that exact same psychological friction. He is not immune to the sting of mistiming. But the difference is, he doesn't let that psychological sting dictate his next trade.
Right.
He feels the regret, acknowledges it publicly, and then completely ignores it when deciding whether to buy today. That is the discipline.
It normalizes the psychological burden of investing. You can be brilliant, you can be profoundly disciplined, and you will still make decisions in hindsight that look suboptimal.
Yeah.
The key differentiator is that his suboptimal decisions still locked in monumental generation-defining gains because the underlying asset was fundamentally high quality.
Now, speaking of generation-defining moves, let's shift our focus from how he accumulates capital to how he strategically redistributes it.
This is a great pivot.
Because the interview revealed a major philanthropic pivot. At 95 years old, Warren Buffett is bringing back an event that the financial world thought was gone forever.
The legendary charity lunch.
The Power Lunch is officially returning. But he isn't just reviving it, he is structurally evolving it.
Right, there's a twist.
He is partnering with NBA superstar Stephen Curry and his wife, entrepreneur and philanthropist Aisha Curry, to host this new iteration of the auction.
Can truly appreciate the significance of this. We really need to dive into the sociology and the history of the Buffett lunch.
Yeah.
Because it is essentially a masterclass in modern philanthropy and network effects.
Where did it even start?
Well, this tradition started way back in the year 2000, and it wasn't even Warren's idea initially. It was conceptualized by his late wife, Susie.
Oh, why?
She wanted to raise money for the Glide Foundation, which is an organization doing incredibly difficult boots-on-the-ground work for the homeless and low-income populations in San Francisco.
And for the first few years, it was a relatively modest affair, right?
Right.
A live in-person auction that raised respectable but not earth-shattering amounts of money.
Correct. But the inflection point occurred in 2003 when they moved the auction online to eBay. That single decision globalized the event. The bids started skyrocketing exponentially. The lunch transformed from a local charity drive into the ultimate global status symbol.
It really did.
It became an incredibly exclusive Veblen good. You know, an opportunity to sit across a steakhouse table at Smith & Wollensky in New York or later in Omaha and have unfiltered access to the mind of the greatest living capital allocator.
And it ran consistently every year until the global pandemic paused it in 2020 and 2021. Then in 2022, they brought it back for what was heavily publicized and marketed as the grand finale.
Final lunch.
The ultimate scarcity play. And it went out with an absolute bang, a record-breaking $19.01 million bid. $19 million for a 3-hour meal.
The sociology of who was winning these auctions is fascinating because it accurately maps the shifting tectonic plates of global wealth over the last 2 decades.
How so?
Well, over the years, several highly notable Chinese entrepreneurs and investors paid millions for the privilege. You had people like Duan Yangping, a massive figure in Chinese electronics who founded BBK Electronics.
Yeah.
He actually brought a young Colin Huang to his lunch with Buffett, and Huang later went on to found Pinduoduo, one of the largest e-commerce companies in the world.
That is an incredible detail. The network compounding effect of a single lunch.
Exactly. You also had Zhao Danyang, a hedge fund manager, Zhu Ye, a gaming executive, and the cryptocurrency entrepreneur Justin Sun, who paid $4.6 million in 2019.
I remember that one.
For these individuals, paying millions wasn't just about getting stock tips. It was about signaling. It was about networking. It was about acquiring the cultural capital and the ultimate legitimacy of being geographically and intellectually proximate to financial history.
So if 2022 was billed as the grand finale and he ended it on a $19 million high note, the obvious question is, why bring it back now, 4 years later, in 2026? What changed his mind?
The answer lies entirely in the strategic partnership. Buffett was quoted in the interview saying that he wants to partner with people I admire to create real, sustainable change.
Enter the Currys.
Exactly. By teaming up with Stephen and Aisha Curry, he is orchestrating a brilliant merger of demographics.
He's bridging the old guard of traditional finance with the modern icons of sports, media, and culture.
Yes.
Let's look at the specific logistics they laid out for this new event. The eBay auction is scheduled to run from May 7th, starting at 7:30 p.m. Pacific Time. It will conclude on May 14th. The lunch itself is slated to take place on June 24th, bringing it back to Buffett's home turf of Omaha.
But the most crucial structural change is the distribution of the beneficiaries.
Right.
In the past, the massive windfalls went solely to the Glide Foundation. Now the proceeds will be split evenly. Half will continue to go to Glide in San Francisco, honoring and continuing Susie Buffett's original mission.
That's great.
And the other half will be directed to the Currys Foundation, Eat, Learn, Play, which focuses on children's nutrition, education, and physical activity in the Oakland area.
It is essentially a passing of the philanthropic torch. Buffett understands the mechanics of his own brand. He knows his name is the lure that draws the Wall Street billionaires, the hedge fund managers, and the international magnates. But the Currys draw a completely different, younger, highly influential demographic of wealth and cultural relevance. By combining their gravitational pulls, they are mathematically maximizing the charitable impact.
It's genius.
It proves that even at 95, Buffett is actively engineering ways to leverage his legacy to ensure the machinery of wealth redistribution continues functioning long after he is gone.
It is a textbook example of strategic philanthropy. He is utilizing the terminal value of his own brand to permanently elevate their foundation's brand. He's effectively creating a sustainable philanthropic franchise that bridges generational wealth.
But as fascinating as the charity lunch is, the 2026 interview wasn't all just about philanthropy and capital allocation.
No, it definitely wasn't.
This is where the tone of the conversation took a very sharp, very serious turn. The hosts of Squawk Pod pushed him into some highly sensitive territory regarding his personal associations.
Yes, the interview ventured directly into the ongoing fallout from the Jeffrey Epstein files, and specifically Buffett's relationship with his longtime friend and associate, Bill Gates.
For decades, Warren Buffett and Bill Gates were viewed as the ultimate billionaire best friends.
They really were.
They played bridge together online. They co-founded the Giving Pledge, fundamentally altering how the ultra-wealthy approach philanthropy. They served on corporate boards together. They were intellectually and socially inseparable in the public eye. But in this interview, Buffett made a stark, unequivocal revelation. He stated publicly that he has not spoken to Bill Gates since the Epstein revelations surfaced.
The media often tries to frame this kind of separation as a personal falling out, a dramatic end to a friendship.
Which is natural to assume.
But if you analyze Buffett's exact reasoning in the interview, this is purely about corporate governance and tail risk management. Listen to his pragmatic justification. He said, I don't want to be in a position where I know things and then get subpoenaed.
I don't want to know things and get subpoenaed. That is an incredibly calculating statement.
Very cold.
To an outside observer, it might sound cold, almost ruthless, to sever a multi-decade friendship over potential legal proximity. But we have to look at it through the lens of fiduciary duty.
Exactly. It is the ultimate corporate firewall. Think about the mechanics of institutional risk.
Okay.
If the chairman of Berkshire Hathaway is subpoenaed in a highly publicized, deeply controversial federal investigation, even if he has done absolutely nothing wrong, the risk premium on Berkshire's stock immediately skyrockets.
The market would panic.
The distraction to the board is immense. The reputational damage by association is unquantifiable.
So what does this all mean? He is actively protecting the shareholders from his own personal history. He acknowledged their past friendship in the interview. He didn't try to erase history.
Right, he was fair about that.
He praised the massive charitable work they accomplished together over the years. But he is drawing an absolute impenetrable firewall around his legal and reputational safety. He is refusing to say anything more until all the facts are cleared up by the authorities.
He is subjugating personal sentiment to the preservation of the institution.
It is a ruthless pragmatism, but it is entirely consistent with his lifelong philosophy of risk management.
It really is.
It is the exact same pragmatism that allows him to hold $370 billion in cash when everyone else is buying overvalued tech stocks. He ruthlessly eliminates emotional decision-making. If a stock is fundamentally too expensive, he doesn't buy it, no matter how much he likes the underlying products. If a personal association suddenly poses a severe legal and reputational tail risk to the company he spent 60 years building, he immediately cuts communication, no matter how much history they share.
The preservation of the whole always outweighs the comfort of the part.
And that overarching theme of supreme risk management transitions seamlessly into his broader macroeconomic and geopolitical worries during the final segments of the interview.
Yes.
Because if you want to know what actually keeps a 95-year-old billionaire up at night, it is not the day-to-day fluctuations of the S&P 500. The sources note that while they briefly touched on prediction markets, Buffett expressed deep, profound concern over the escalating Iran war.
Geopolitical instability is the ultimate unquantifiable variable.
It really is. You can't model it.
You cannot accurately model a regional war on a discounted cash flow spreadsheet. When a major conflict escalates in the Middle East, the immediate threat is to the Strait of Hormuz.
Right.
Supply chains fracture, global shipping insurance premiums skyrocket, energy prices spike violently, and global trade routes are fundamentally threatened. Buffett understands that a localized military conflict has massive, immediate ripple effects across the entire global macroeconomic landscape.
And what was truly fascinating was how he tied this geopolitical fragility directly to domestic monetary policy.
Oh, this was a huge moment.
He was asked by the hosts about the Federal Reserve's current trajectory, and he admitted that if he were sitting in the chairman's seat at the Fed right now, he would heavily hesitate to cut interest rates.
Which is completely against what Wall Street is currently demanding. Wall Street always wants cheaper money.
Always.
They want rate cuts to juice equity valuations. But Buffett is looking at the historical precedent of the 1970s.
What happened then?
During that era, Fed Chairman Arthur Burns prematurely cut rates while underlying inflation was still a threat. This led to a massive resurgence of inflation that required Paul Volcker to hike rates to brutal levels to finally break it.
So Buffett's primary anxieties in 2026 are the trajectory of inflation and the underlying stability of the banking system. He is looking at the chessboard 5 moves ahead.
Exactly.
He is saying, look at the geopolitical fragility with Iran. If this causes an energy shock, inflation is going to reignite. If the Fed cuts rates prematurely in that environment, you risk structurally embedding inflation into the economy for another decade.
Why pour monetary gasoline on a geopolitical fire just to appease the stock market in the short term?
Exactly.
His stance on the Fed perfectly mirrors his stance on his own capital. It all circles back to defensive posturing. The $370 billion parked safely in short-term treasuries, the strict firewall distancing himself from gates and potential subpoenas, the warning against premature rate cuts.
It's all connected.
Every single move he is making in 2026 is about ensuring that the castle of Berkshire Hathaway is absolutely impregnable to whatever systemic shocks are coming next.
So let's bring all of these complex threads together as we wrap up today's deep dive. We started with the visual of a 95-year-old man calling his trading desk before the bell, and we've unpacked the incredible architectural complexities of his reality in 2026.
It's a fascinating reality.
Warren Buffett at 95 is a man hyper-aware of his legacy. He is intensely guarding his legal exposure. He is acutely aware of the fragility of the global market.
He is a study in contradictions that actually makes perfect mathematical and strategic sense when you understand his core philosophy of risk.
Yeah. He has officially stepped back by giving up the CEO title to Greg Abel, but he refuses to step down, maintaining his daily operational rhythm. He commands a mind-boggling $370 billion in cash, yet he complains there's absolutely nothing worth buying.
Right.
He generated over $100 billion in pure profit on Apple, yet he still wrestles openly with the regret of wishing he had played the execution differently. If there is a unifying takeaway from this analysis, it is the sheer power of profound, almost painful discipline. We casually talk about discipline in investing all the time, but actually executing it is entirely different.
It's the hardest thing in the world.
Holding $370 billion in a pressurized accumulator, while the rest of the market is actively trading, making noise, and celebrating paper games, that takes an immense, almost superhuman psychological fortitude.
Absolutely.
To do absolutely nothing when the institutional pressure is immense to do something is perhaps the rarest and hardest skill in capital allocation.
It is the ultimate discipline to wait for the fat pitch. He refuses to swing just because he is standing in the batter's box and the crowd is yelling. He waits for his exact, mathematically rigid criteria to be met.
Even if it takes years of waiting.
And even if it requires a 50% macroeconomic crash to manifest the opportunity.
Which brings us right back to where we started. We painted the picture of that daily morning phone call before the opening bell. The legendary director still sitting in the editing room holding the scissors, but having given away the right to the final cut. Buffett has explicitly and carefully structured Berkshire Hathaway to survive him. He has put the rules in place. He has given Greg Abel the ultimate veto power. But I want to leave you with a final lingering thought to mull over on your own today.
What's that?
When a single man's daily phone call to a trading desk still carries the gravitational weight of a $370 billion war chest, are we witnessing the perfect corporate succession plan, or just the longest, most profitable goodbye in financial history?
It's a brilliant question. The architecture of his exit appears to be just as complex and just as meticulously calculated as the architecture of the empire itself.
Thank you so much for joining us on this deep dive. Stay curious, keep questioning the consensus, and keep learning. We'll catch you on the next one.